Hey guys, welcome to Money Mindset and More. And today's discussion is around how to determine the value of a company if it is sold to another company and if there is any universal formula for that. As per my experience, there is no universal formula for those kind of valuation. There are different methods which you can follow, and I will cover some of those, but you can follow any one of those methods to figure out what should be the value of a company. And the first method which I'm going to cover is asset based valuation. And there are two ways you can do asset based valuation. One is your book value valuation. So, what it means by that, you take out your assets, you pay out all the liabilities, whatever is the remaining amount is the value of the company. Let's say you don't want to continue the company, so you want to sell those assets. When you sell those assets, normally they can either go higher or lower. That is called liquidation based valuation. So if you sell your assets after paying your liabilities, it will be a liquidation sale valuation. Those are two forms of asset based valuation. Then comes the market based valuation, which is basically you do a comparable company analysis and see how they are valued in the market, and based upon that you decide what should be the value of the company which you are buying or you are selling. Also, you can see previous transactions, what has been done for the similar kind of company in the similar industries. That can be also a form of valuation when it comes to market based valuation. The third one is income based valuation, and I think that is used mostly for startups and growth companies. And you must have heard discounted cash flow valuation. What it mean by that is you'll project your future cash flow, and then you discount those cash flows to the present value to find out what will be the value of the company. So simple example, let's say you will have $100 cash flow in 2026 and your discount rate is, let's say, 5%. Then you'll discount each year 5% and you come to a value for 2024. So it will be 5% for 26, 5% for 25, and that's the value. So somewhere around, let's say, if I take out 5% is 95, and then 5% of 95 will be somewhere around 90. So that should be your present value based upon the $100 future cash flow. And then you can do capitalization of your earnings, which is basically your estimated value based upon expected future profits and based on what are the capitalization rate for those profits. That is another method which you can use. I have seen those has been used for long-term companies. For example, heavy engineering, Boeing or something like that, where you have a very longer cycle, the material cost and everything changes over time. Then you have to see this method can be used far better than discounted cash flow. The next one is your earning multipliers, and you must have seen that uh, the most used word is EBITDA or net income. So EBITDA is nothing but your earning before interest, depreciation, and taxes, or it will be net profit, which will be after deducting all those expenses. And then you decide on a multiplier for certain industries. What can be? It can be, let's say, 2 times, 3 times, half times, something like that. And you multiply that number with your EBITDA or net income, and then you find the value of the company. That is also used a lot in startups, uh, and can be seen in all the valuation if you have seen the market. Last one is sometimes you acquire for strategic reasons. So let's say you want to enter in a market, or you want to enter into a distribution channel, or you want to enter into any technology. And if you want to develop those things, it will take years and years of effort and resources. So you give somebody more valuation and buy them. A classic example was Coca-Cola. When they entered India, they bought Thumbs Up, which was a local brand, but has a very wide distribution network, and they just use that network to distribute all their products. Same can be analyzed in other industries also. For example, Amazon has acquired Whole Foods in US, and they are using that as a distribution and what you call grocery business, which they were trying to do themselves, but they were not able to scale it. So yeah, they are using that as a distribution to sell their own products, returns, and things like that. Another good example for that. If you see Accenture and IBM, they do a lot of technology acquisition for their businesses, and those are always based upon if they have to develop those technologies or expertise, how much time it will take, and they take the multiplier and then they pay the company to acquire it. So that's a strategy that is also very common in, I would say, current scenario, where strategic acquisitions are very common across geographies, across companies. So these are the some of the methods. You can go in detail with any financial expert, but discounted cash flow and earning based, which is EBITDA, are the most common ones to be used. Let me know you have any other questions, and like, share, and subscribe. Thank you so much. Take care.